If China's economy were a large puzzle, the property market would be the key component holding it all together. The puzzle appears beautiful, but upon closer inspection, you will see that one important component has tiny cracks in it. These cracks, which go unnoticed often, indicate that something significant could be approaching. These signs cast doubt on the storm that doesn't seem to be stopping, making investors and experts wonder if the foundation is starting to fall apart. We should look more closely at these signs, which are like puzzle pieces that could change how we see China's economy. Are China's largest cities grappling with high debt ratios, local government troubles, and a vast excess of housing inventory? Is China's real estate crisis deepening as the housing market faces oversupply and declining property values? Join us as we explore these pressing issues. One of the most significant economic sectors in China is the real estate industry. Ever since the country's housing market was established in the late 1990s, the real estate industry has grown faster than the GDP of the nation. From 4% in 1998 to 7.2% in 2020, and then back to 6.1% in 2022, its GDP share rose. In China's national accounts, real estate is categorized as a tertiary or service industry, mainly involving the purchasing, leasing, selling, and management of real estate. The impact of real estate on the economy is significantly higher when other real estate-related activities like building, remodeling, and upkeep are also considered. However, the industry saw a downturn in 2022 when national real estate sales dropped by 27% from the year before. The amount of new loans that banking institutions made to real estate developers fell to its lowest point in nearly 10 years. Consequently, real estate development investment fell by 10% over the previous year. Furthermore, hundreds of current housing projects came to a halt due to the liquidity constraints of numerous developers. By the end of 2022, there would be a 15% fall in housing completions and a roughly 40% decline in housing starts. But this collapse, or almost collapse scenario in 2022, was simply the outcome of long-lasting events combined with a domino effect. What went wrong? Has the Chinese housing market already collapsed? Share your thoughts in the comments section after our exploration. Market dynamics, evolution. From deleveraging success in 2021 to the housing downturn in 2022. Chinese developers work with a business model that is defined by significant leverage, dynamic sales, and quick project turnovers. But when these developers face immediate financial difficulties as a result of interruptions in their funding sources, the model's underlying fragility is made clear. In the last 10 years, a large amount of capital has gone toward real estate, which has led developers to expand into the banking industry. Chinese policymakers are concerned about the complex relationships between real estate and the banking system. Beijing responded by enacting the Three Red Lines policy in August 2020, which placed restrictions on new borrowing endeavors by developers. This was a calculated decision made in the midst of a hot housing market and an economic recovery after the COVID-19 pandemic. The policy appeared to be working at first, as 2021 saw a slow deleveraging and a cooling off in a number of indices, like as sales and real estate investment, even though they were still in expansionary zone. Nevertheless, in 2022, things unexpectedly changed. The highly transmissible Omicron variant that has been circulating since early 2020 has contributed to China's worst COVID outbreak since the Wuhan outbreak. China enforced broad lockdowns as part of the zero-COVID policy in an effort to eradicate the disease. These lockdowns severely reduced the demand for houses and made real estate developers' financial difficulties worse. An increasing number of developers defaulted on record amounts of bonds in both onshore and offshore markets during 2022 as a result of the housing market slump, restrictions on funds from home pre-sales, and restricted access to loans and bonds. many home developments came to an abrupt halt in construction as liquidity issues worsened. As a result, several buyers who had already started making mortgage payments became increasingly irate and refused to continue. China is still dealing with a complicated web of problems stemming from these concerns, which have not only affected the financial health of developers, but also left a trail of dissatisfaction within the real estate industry. Debt pileup, crucial significance of increasing debt to asset ratios. Over the past 2 years, the protracted financial crisis at the China Evergrande Group has frequently made headlines throughout the world, highlighting the perilous situation of China's highly leveraged real estate development business. This unrest is indicative of wider patterns, as Chinese real estate developers struggle with an increasing debt-to-asset ratio that currently averages about 80%. Based on past statistics, this ratio has increased significantly, reaching a peak of 80.7% in 2020 after rising from 75% between 1997 and 2008. The general trajectory shows a consistent increase over more than a decade, despite a little decline to 80.3% in 2021. This rise has its origins in 2008, when the global financial crisis made real estate a growth engine for the economy. It is interesting to note that larger Chinese developers typically have even higher debt loads. By revenue, the 5 biggest developers had an average debt ratio of a healthy 85.3% by the end of 2020. This amount greatly exceeds the debt-to-income ratios found among the largest property developers in the US, Japan, and Hong Kong. The Chinese housing market's impending crisis, city expansion, and land finance. The rapid expansion of Chinese cities has been fueled by the use of land finance, a tactic that is ultimately proving to be unsustainable and full of difficulties that could make the country's housing market crisis worse. Over time, the over-reliance on land finance has resulted in the unwarranted urban sprawl with dire forecasts of an impending land shortage. The process by which local governments obtain capital through financial transfers of land has propelled this expansion and significantly expanded city scales. Unquestionably, this has accelerated China's urbanization process and boosted its urban development. But a closer look reveals the shaky basis this expansion is based on. Based on data from the China Urban Statistical Yearbook, China's urban built-up areas have expanded rapidly in the past 20 years. However, because it mostly depends on the acquisition of rural common land, this growth comes at a price. The effects of this growth are numerous and include a steep drop in the amount of land under cultivation, farmer displacement, and the problem of inadequate compensation standards for land acquisition, which is frequently made worse by cases of illicit land transactions. The future seems dismal as the amount of rural areas surrounding cities decreases, further complicating problems. The practice of overdrawing on future development space is unsustainable and has serious ramifications, including the possibility of a crisis in which cities will run out of land for expansion and requisition. This, in turn, exacerbates the growing concerns about the stability of the Chinese housing market and highlights the need for a more sustainable approach to urban development. Supply-demand relationships and the Chinese real estate crisis. When conversations about China's housing bubble arise, the focus usually shifts to the skyrocketing costs of homes in major cities like Beijing and Shanghai. But digging a little more shows a complex story, especially when taking into account the smaller cities that are frequently left out of these discussions. The cost of housing is comparatively lower in these metropolitan areas, which stands in sharp contrast to the difficulties that their larger counterparts encounter. A common problem in smaller communities is an overabundance of housing supply compared to demand. Dissimilar to the frenzied markets found in megacities, these regions face a unique set of difficulties, resulting from an imbalance between supply and demand. Rather than being a blessing, the more affordable housing costs make matters worse, because there is an excess of available units but not enough demand to fill them. Examining this supply-demand imbalance highlights a recurring issue in the Chinese real estate market. Smaller communities manage the challenges of unused housing inventories, while megacities struggle with the burden of increasing costs. The differences in difficulties faced by big and small towns complicate the story of the collapse of the Chinese housing market and call for a more careful analysis of local dynamics and how they interact with the stability of the real estate industry as a whole. Examining the intersection of supply and demand. A severe mismatch between supply and demand plagues the Chinese housing market, creating a risky dance that further skews the equilibrium price and intensifies the crisis. In the real estate market, supply and demand play a crucial role in establishing the equilibrium price. A deeper look, however, reveals a distortion in this delicate balance that is mostly caused by the strategic choices creators make. Developers have boosted the supply of commercial housing dramatically in an effort to maximize profits and position. Regretfully, this has resulted in a significant decrease in the supply of affordable homes, which has severely distorted the market as a whole. The complexities of this disparity deepen when developers take advantage of current gaps in domestic laws that are laxly enforced. The result is an increase in the percentage of upscale, large-scale residential properties, which pushes cheap and low-rent housing options out of the market. Concurrently, there is still a significant dearth of small-scale business housing, which exacerbates the housing scarcity in the rigid demand category. Essentially, the lack of construction in the common, low and medium-income housing segments exacerbates the market's lack of effective supply. As a result, the equilibrium price continues to be persistently high, which greatly adds to the high levels of housing prices that are currently seen in the Chinese housing market. This complex mismatch creates the conditions for a crisis in which the skewed dynamics of supply and demand act as a forerunner to the more extensive problems confronting the Chinese real estate market, leading it in an unpredictable direction. A complicated interplay of growing aspirations, financial ambitions, and developer influence converges in the rich tapestry of the Chinese housing market to set the stage for an impending disaster. Locals are trapped in a contradictory situation since they have strong expectations that housing costs would keep rising. Faced with the daunting obstacle of excessive housing expenses, people are trying all available means to accumulate money for buying a piece of real estate. The fundamental reasoning is simple. There is a widespread perception that delaying a purchase would only lead to higher expenses in the future. Two different incentive structures are driving this sentiment. Most locals see homeownership primarily as a calculated investment to reduce inflationary losses rather than just as a place to live. There is an unrelenting push to enter the housing market because buying a home is seen as a simple and accessible way to protect against financial depreciation in the face of economic uncertainty. Real estate developers, secondly, deliberately sway public opinion by spreading the myth that housing prices will only rise but not fall. This calculated planning raises consumer expectations and causes a rush to purchase real estate before other opportunities arise. As a result, the ensuing zeal intensifies the trend of rising house prices, feeding into the larger-scale dynamics of the market. The 2008 global financial crisis's domino effect. A critical turning point in the history of the Chinese housing market collapse occurs in the midst of the 2008 global financial crisis. China carried out massive construction projects and enacted a number of lax monetary policies in an effort to rescue the economy. Although these actions effectively navigated China's economy through difficult seas, they also planted the seeds for a series of unfavorable outcomes, most notably the escalation of the real estate bubble. These measures had an effect on vital industries like steel and cement, where businesses struggled with serious overcapacity problems. Data indicates that the surplus production challenge faced by China's steel and cement industry resulted from outputs exceeding societal wants. Due to the overabundance that flooded the market, prices for materials, particularly those essential for building homes, went to astonishingly low levels. In a paradoxical way, the decreased market prices not only indicated a surplus of materials, but also produced a favorable atmosphere for making money. The affordability of construction materials created enough profit space, fueling the overcapacity-driven real estate market. A story of unforeseen consequences emerged from the interwoven web of market dynamics that had their origins in the aftermath of the 2008 financial crisis. China's loose monetary policies, which were meant to boost domestic demand and promote higher output, ended up having two unintended consequences. Although most businesses benefited from these measures, the real estate industry was disproportionately affected by overcapacity-driven growth, which set the stage for the ensuing housing market catastrophe. Constant oversupply of houses. A considerable overabundance of unsold flats is one of the main roadblocks to the recovery of the Chinese housing industry. China has more than 3.5 billion square feet of completed but unsold apartments as of February, according to data source Wind. This overstock, which some estimate to be equal to 4 million dwellings, represents the worst scenario since 2017. China implemented a slum clearance campaign that year with the goal of destroying outdated, decaying structures in order to increase demand for new dwellings. Based on projections by property consulting firm China Real Estate Information Corp., the percentage of newly finished apartments that went unsold in 2022 was around 1/3, which is the most since 2015. Economists claim that smaller cities with populations of a few million or fewer exhibit a particularly noticeable surplus. In a report released last year, economists Kenneth Rogoff and Yuanqin Yang noted how, as a result of an enormous building boom, over 640 Chinese localities, classified as third tier, now hold about 80% of the nation's total housing supply. In comparison to major markets such as Beijing and Shanghai, where populations and job markets have grown more quickly, demand in these cities is lower. According to estimates from China Real Estate Information, Beihai, a well-known third-tier city, would need about 6 years to use up all of its unsold property. Shanghai, on the other hand, would take 7 months, and Beijing over 2 years. According to China Real Estate Information, it would take 20 months on average for the surplus home supply in the 50 cities it tracks to be absorbed. To put things in perspective, the National Association of Realtors reports that there is presently a 2.9-month supply of existing homes in the United States, while U.S. government data indicates that there is an 8.2-month supply of new homes. The property dilemma: how investment practices fueled the Chinese housing market crash. The importance of real estate as an investment has been apparent in the maze-like collapse of China's housing market, contributing to the crisis. The nation's economic situation is vividly shown by the fact that the property industry accounts for as much as 70% of household wealth. Over time, the unwavering rise in home values has made real estate seem like an alluring financial prospect. The appeal of real estate as an investment grows when one considers the fact that China does not have a property tax, a gap that will be discussed a little later. The current state of the economy has made it possible for families and individuals to go on a speculative buying binge, purchasing second or even third homes in the hopeful expectation that values would continue to rise. In the middle of all of this excitement, the phenomenon of pre-sale real estate has emerged as a symbol of the complex relationship between finance and the real estate industry. Developers of real estate engage in the sale of unbuilt homes, creating a risky nexus where financial speculation meets the early phases of China's property market problems. The market is more volatile and risky due to the spiraling investing activities, which are further highlighted by the lack of a property tax. This frenzy for investment has far-reaching effects, laying the groundwork for the complex dynamics that are contributing to the crisis that is developing in the Chinese housing market. Chinese property developers, profits, debt, and government intervention. China's property boom over the last 2 decades has made property developers powerful players in the corporate world. The National Bureau of Statistics, NBS, reports a 21.8% annual growth rate in commercial home sales from RMB 5.8 trillion, 914 billion in 2011 to RMB 17.3 trillion, 2.7 trillion in 2020. These developers built 16.4 trillion square meters of residential housing in 2020, accounting for 73% of all new developments. In 2020, property developers relied heavily on deposits and pre-sales, as well as speculative expenditure from individuals and businesses. These two income sources helped property developers earn over RMB 6.6 trillion, 1 trillion, at this time. Credit is crucial for ambitious projects' liquidity. Property developers borrowed RMB 2.6 trillion, 419 billion, in 2020, showing their dependence on borrowed financing. However, debt is rising alongside financial gain. According to Nomura, the property development business owes RMB 33.5 trillion, 5.2 trillion as of June 2021. The government's growing worry over industry debt led to the 3 red lines policy in August 2020. This regulatory step limited major developers' lending, marking a turning point in the sector. China's real estate crisis spilling over into the global economy. It's not just China that's feeling the heat from its real estate crisis, it's starting to ripple out into the global economy. The International Monetary Fund, IMF, recently slashed its global growth forecast for 2024, and guess what? They specifically pointed to China's real estate mess as a big reason why. But that's not all. Rising inflation and interest rates are also causing headaches, but the IMF made it clear. China's real estate crisis is a major problem that policymakers will have to tackle as we head into 2024. Diminished consumer confidence and shaky investment in China? Those aren't just local issues. They're a significant risk for the entire global economy. Imagine this: a country as massive as China, where the real estate market has been a cornerstone of its economic strategy, suddenly hitting a wall. That kind of shock doesn't stay contained within borders. When China sneezes, the world feels it. And right now, with consumers hesitant to spend and investors pulling back, that sneeze is turning into something more serious. As China grapples with these challenges, the effects are rippling out to the rest of the world. Countries that rely on trade with China, especially those that have deep economic ties, are already feeling the pinch. The IMF's warning isn't just about numbers on a spreadsheet, it's a wake-up call for anyone keeping an eye on the global economy. The situation in China is complicated, with layers of economic strategies and policies all coming to a head at once. But one thing is clear: what happens in China doesn't stay in China. The global economy is interconnected, and when a major player like China stumbles, everyone else has to watch their step. With that, we have reached the end of today's show. If you have come this far with us, be sure to check out other videos on the channel.